Hi folks, welcome back to our Forex trading. Today we are doing episode 4 of Forex Advanced. In today's lessons, I want us to dwell or to cover on what we call a trading plan. Okay, so a trading plan is just like a business plan. If you are doing business or if you are planning to venture into business, you'll need to do a business plan for the specific business that you're doing, okay, or that you want to do. The business plan will act as a guide, okay. It will act as a guide, showing you what exactly you need to do, the steps you need to take, so as to ensure that your business succeeds. In Forex trading, a trading plan acts the same way as a business plan, okay? And we can define and say that a trading plan defines what is supposed to be done, why, when, and how, okay? And this covers your trader's personality, personal expectations, risk management rules, and trading systems. It helps, that is the trading plan. It helps limiting the trading mistakes and minimizes losses since emotions can consume you when money is on the line. Okay. This means that when you have real money trading a live account, emotions are likely to take over. That is especially when you have or you are trading in losses. When you have some losses while trading, it's very easy for emotions to go beyond your limit, and this might you might find now that you are beginning to do some various mistakes like revenge trading, which might even cost you more. And therefore, the essence of the trading plan is to ensure that you stick to your trading rules or your trading plan. Anytime that you are trading, ensure that you adhere to your trading plan. So a trading plan eliminates any bad decisions making in the heat of the moment, okay? Because you have somewhere you can refer to, you know what to do, what not to do. So this is the essence of the trading plan, okay? So in your trading plan, as we said, this is like your rules, okay? So I will just guide you on how to be able to create or to come up with a trading plan, okay? So let's say, for instance, you want to now venture into serious trading, or you are trading now. Trading is your business, it's your life income, or it's even your side hustle. You want to do it seriously. So one thing that you need to do, you need to set rules. Okay. So for instance, you can say that you will be able to identify maybe a certain trend for you to be able to trade. Okay. So this we can call it like trade direction. So let's say for the trade direction, you'll only want to be bullish. Okay. So bullish, meaning that you'll only be doing buy position, buy positions. Okay, buy positions only. Okay, so anytime the trend is bearish, you're not opening any positions or you're not trading. Why? Because you're sticking to your trading plan. Okay. The other thing, you need to choose a time frame that you need to trade from. Okay, a time frame. So let's say you choose 30 minutes time frame. 30 minutes time frame. So anytime you're trading, you'll do your analysis from the monthly, from the weekly, from the daily, from the 4 hour, from the 1 hour. You narrow down all the way to the 30 minutes. And it is from the 30 minutes time frame that you'll be able to take your trades once a probable or high probability setup occurs. Okay. So if you are taking your trades from the 30 minutes time frame, you'll need to ensure that you set your stop loss in the 30 minutes time frame, and you set your take profit using the 30 minutes time frame. Stick to the 30 minutes time frame. If you choose another time frame, stick to that time frame. Okay. The other thing, you want to define or to know what defines your high probability setup. So what defines your high probability setup? Okay, so this is what you should be able to see in the chart for you to know that this is a high probability setup, and therefore you'll trigger either a buy. That is if you're only going to do buy positions. If you're only going to do sell position, what will be able to trigger you to make you trigger the sell button. Okay, remember, this is your plan. Okay, so let's say this is person A making his plan. Person B can decide that he will do both sells and buys. Okay, so he or she is not limited to buys only. Okay, I hope you're understanding me. So this is an hypothetical plan that I'm showing you how to come up with one. So what defines your probability setup? So some will use indicators, and others like me will use bear charts. Okay, that is plain chart, or what we call price action. Okay, plain chart, or what we call price action. So if you are going to use indicators, you need to label clearly what you need to see indicators do, and what types of indicators exactly are you going to use. So for instance, you can use the moving average, okay? And with the moving average, that is the moving average, maybe you can use the crossover, the crossover strategy. That is when the moving average crosses over in the upside direction and pointing up, you look for your buy positions. When they cross over in the downward side, pointing downward, you look for your sell position, okay? So also maybe you can use, like we said, you cannot only rely on one indicator only. Ensure if you are using the indicators, ensure you use at least 2 indicators or more to ensure that it's a high probability setup. Let's say maybe if you want to confirm trend and you're using indicators to confirm trend. So we saw the trend indicators. You can use the what? The RSI. You can use the stochastic, okay? The stochastic. So all these indicators needs to confirm an entry for you that the setup is clear now. All the indicators are confirming that the setup is clear, and now you can engage the market, okay? So the other thing you need to understand, or you need to come clear with, is your exit, okay? You need to define your exit. What will make you exit the market? So if you're using the indicators, if you're using the moving average, you're using the RSI and the stochastic, what will make you now perceive that the trend is over and the market is about to reverse, and now you need to exit the market? So number one, that is if the moving averages, maybe the moving averages gives a reversal signal. That's they give a reversal signal. They give a reversal signal. So the other thing is maybe for the RSI, it also gives a reversal signal. So if you're in a buy position, so how will the moving average give you a reversal signal? So maybe you might see them doing what? Crossing over on the downside and pointing downward. So you know that now the trend is reversing. Therefore, you exit the market. The RSI will be above the 70 mark, between 70 and 100. So you know that the market is what? Is overbought. So it's about to sell. Therefore, you exit your buy position. The same case to stochastic, it will be in the 80, 100 levels. Okay, so once it is in those levels, you know that the market is overbought and it's about to reverse. So with the stochastic, it has two lines. So once the lines cross over and point downwards, you know that now a reversal is happening. So you exit your buy position. The reverse is true for the sell position. Okay, so in your trading plan, so we have already defined our entries, we have already defined our exits. Okay, so the other thing that needs to be in your trading plan is the risk management. Okay, so when we talk about risk management, we last time in the previous episode we discussed some aspect of risk management strategies. So this needs to appear somewhere in your trading plan. So for the risk management, one key thing that you need to take note of is the risk to reward ratio. Okay, risk to reward ratio. Risk to reward ratio. So I said, or I've been saying in my previous episodes, that a risk to reward ratio of 1:3 is best. This is a risk to reward ratio that will ensure you're profitable in the long run, even if you have some uh, amounts of losing trades. That is, if you have a number of losing trades. Okay. So with a risk to reward ratio of 1:3, this means that you are risking 1 to get 3. So in the long run, you might be 60% uh, loser, a 60% loser, and a 40% winner. And in the long run, you are still profitable. Why? Because of the aspect of risk to reward ratio. So always ensure that your risk to reward ratio is 1:3 and above. Okay. So that way you'll be profitable in the long term. The other thing that needs to be in your trading plan, you need to define clearly, maybe define the trading time. Okay, the trading time or sessions. So there are traders who trade only London session. There are other traders who trade New York session only, and there are other traders who trade the Asian session only, and there are traders who trade all session. That means as long as a setup appears in a particular session, they will definitely trade. Okay, so it's up to you to know which session is best for you and which session is not best for you. So you ensure that it is in your trading plan. Okay. The other key aspect is you need also to define the pairs. Okay. Ensure you define the currency pairs that you're going to trade. I usually advise that as a beginner, maybe you can begin by testing each and every currency pair, each commodity. You can begin by testing even the indices and know that and get a picture of which one are you performing the best, okay, in terms of analysis, in terms of profitability. And once you identify that, you'll now be able to settle on that and build it up, okay? Maybe you can have like a maximum of two, one or two pairs. You can have maybe one commodity and one currency pair. And I tell you, once you narrow down to a specific pair, uh, the trading will be very enticing to you because you will not have to spend a lot of time researching or analyzing different currency pairs. So you know your currency pair, what you trade, you know the asset that you trade, and therefore you'll try to master that asset inside out. Okay, so you'll know its movement, what times it moves the best, how many number of pips this pair moves in a day, and all those stuff. You'll be able to understand that pair inside out, such that even you'll not be needed to do like a lot of analysis on that pair because you'll have mastered it. You'll have mastered the fundamentals that move this currency pair. Anything concerning that asset or commodity, it will be in your fingertip. And therefore, you find that now trading will become a bit easier. Okay. So basically, this is a sample of a trading plan. And this is what you need to ensure that it is in your trading plan. This is what guides you when you're trading, okay? So you ensure that you stick to these rules so that you can be profitable in the long run. Remember, discipline is very key in Forex trading. Discipline is very key in Forex trading. If you want to go far with Forex trading, ensure that you are disciplined, okay? So maybe before I forget, another thing that you can add, maybe you can choose to add a target, okay, or your targets. Maybe you can say that on a daily basis, you are going for maybe 20, 30 pips, okay, 20 to 30 pips. So once you reach these 20 to 30 pips as a beginner, not even only as a beginner, but whatever level of trading you are, you need to stick to your trading plan. If your target is 20 to 30 pips daily, once you get your 30 pips, okay, exit the market and wait until the next day you trade again. Why? Because out of experience, I have known to come that the more you trade in the market in a particular day, the higher the chances that you are going to lose, especially as a beginner. Therefore, you want to be disciplined and ensure that you stick to the plan that you have, so that you can minimize your chances of losing or your chances of scooping losses in the market. Okay, so always have a certain target and ensure that you stick to that target. Okay, so let's say you get uh, maybe a setup, and you see that this setup can give you up to 100 pips. So what do you do in this case? Do you want maybe someone will ask me, do I only take 30 pips and leave the money on the table? I will tell you definitely no. Okay. So how you can be able to handle such, ensure that once you know you see such kind of a setup, use what we call trailing stop loss. Okay. All uh, take partial profits, that is profits equivalent to your daily targets, and break even. Set stop loss at break even and let the rest of the market do what? Flow and go to where it wants to go. Okay. All the best way is to use a trailing stop loss. So as the market goes higher and higher, you follow it with a trailing stop loss, meaning that you are securing your profits. And such one trade, you can get one trade maybe on a Monday, and it gives you 100 pips. And 100 pips, these are your what? Your weekly targets. Okay. So again, don't leave money on the table, because you find that most of the traders, they leave money on the table. So irrespective of your daily targets, don't leave money on the table. So what I mean by daily targets, maybe you get a trade and it gives you 30 pips and TP is hit. So what I mean here, don't go and open another trade looking for another 30 pips. That is going against your trading plan, okay? But you can take one trade that has a high probability of giving even to 100 pips. So what you do, you trail your profits, or you trail your stop loss such that you are securing your profit as the market continues going towards your target, okay? So that way, you'll be respecting your trading plan. So let's look at what we call a trading journal. So what is a trading journal? So by definition, a Forex trading journal is a log of your trades that can help you refine your strategies based on learning from previous experiences. You need to understand that while keeping one is difficult, that is, keeping a trading plan is difficult because most of the traders, they see that this is a lot of hard work, okay? So it is difficult. You need to understand that recording your trades can help answer some of the critical questions about your trading techniques. So over time, the trader will be able to identify characteristics of winning or losing trades. So in a trading plan, what basically you need to do is you need to log in your trades, the trades that you take. Let's say today is April 12th. So I need to, before I explain that, how to create this trading plan, you need to have maybe the number of trades, then you have the date, you have the time, you have the pair that you're trading, the order type, the entry price, take profit, stop loss, whether it's a win or a loss, the number of pips, the amount you made, comments, the lot size, and maybe you can have the cumulative balance. Okay, so I will explain each and everything of these aspects. So let's say today on April 12th, you take your first trade. So you'll come there and say it's April 12th, 2023. Okay, you take your first trade. Then what was the time that you triggered that trade? The moment that you clicked the buy or sell button. Let's say it was 11. 11 a.m. Okay, so write 11 hours in 24-hour clock system. Then which pair were you trading? Let's say this was gold. Okay, so let's say this is gold. So gold is XAU USD. Order type, was it a buy or a sell? Okay, so maybe you can say it was a market what? Uh, instant execution, sorry, instant execution buy, okay? Or maybe it was a buy limit, or maybe it was a sell limit. So you can say, let's go with instant execution, that is buy order. So this is where you click the buy button, immediately the setup appears. So your entry position, let's say it was 1999 point maybe 12. Okay, so your TP, let's say you are going for 30 pips, so and it was a buy, so this means is your TP will be 19, that is 202.12, so those will be 30 pips. Okay, then your stop loss, let's say is 10 pips. Maybe you can say, I'm just doing an hypothetical example to show you how to do or to log in everything in your trading journal. So if your stop loss was 20 pips, so that will be 1998.12. Okay. So let's say that was a win. It was a winning trade. Okay. So if it's a winning trade, you just write W. Okay. So the number of pips, it hit our 30 pips take profit. So maybe the amount that we made there, let's say it was $9. Okay, $9. Okay, so with $9, so it means that our lot size was around 0.03, right? So, and now here you write the cumulative. What is the balance of your account? Let's say you began with $100. So after making $9, the balance will be 109. Okay. So the comment here, this is where you write the strategy that you are using. Let's say moving average crossover. Okay. Moving average crossover, and it was in the 15 minutes time frame. Okay, that needs to be clearly indicated in your trading plan. Okay, moving average crossover, 15 minutes time frame. So the essence of this trading plan, let's say this you continue logging in this the following day, tomorrow, the day after tomorrow, and at the end of the week, you'll have some winning trades and you'll have some losing trade probably. Okay, so the trading plan will, the trading journal will help you. If you have some losing trades, you'll go into your charts, look at that particular day that you had a losing trade, which particular time and which pair, and what did you do? Was it a buy or a sell? What was your entry price? What was your take profit, stop loss? What was the comment? Which time frame did you use? So with this, you are able to go back to the chart and retrace exactly what happened, or what did you see at that moment that did not turn out as you had expected. Okay, maybe you realize that you had overseen a certain strategy and assumed that it was a certain setup forming up, but eventually it was not. Or maybe something happened that made the trade to be a loser. Okay, so you'll be able to know that reason. And if you know that reason, probably a mistake, you'll avoid that mistake the next time. Okay, so let's say again, you have had a couple of winning trades, like maybe 15 trades, winning trades out of 12 losing trades. Okay, so you'll be able to look at your winning trades and see which strategy you've been using uh, that gives you the highest number of wins. Okay, and therefore you'll be able to perfect with that strategy. So, but what if you didn't have this kind of a trading journal? So it means that you'll not be able to know where your mistakes are. You'll not be able to know where your weaknesses are. You'll not be able to know where your strengths are. And therefore, there is nothing that you can capitalize on to improve your trading. Okay. So you'll be just doing trading for the sake of trading. So the reason why I would emphasize that you stick with this with your trading plan or with your trading journal, with your trading plan, and also journal your trades accordingly so that you can have a reference point, especially during the weekend. It is during the weekend that as traders, we look at the previous week, how was it, okay? And we plan out of the same, you're able to plan for the coming week, okay? Because during the weekend, the market is closed, okay? So as I wind up, in the previous video, I had decided to share a spreadsheet that will be able to guide you in terms of knowing the best lot size to use, okay? So let's say you have $100 account. And remember I said you can only do 1 to 3% of your account, okay? Or you can risk 1 to 3% of your account. Let's say that you want to grow your account maybe by 2%. Okay, you want to grow your account daily by 2%. So, and the number of pips, let's say you are targeting 30 pips, okay, and you are risking 10 pips, okay, you are risking 10 pips. So this is a risk to reward ratio of 1 is what? Is to 3. So if you do that and you are growing your account 2% on a daily basis and your starting capital, your starting balance is 100, so it will show you on day one, this is the lot size, okay? The lot size that is needed. So it will show you on day one that you'll need to use a lot size of 0.01, okay? The next day, 0.01. So you'll be using 0.01 for a couple of time until now you reach around $151, whereby now you'll be able to upgrade what? To a lot size of 0.02, okay? So if you key in your starting balance, let's say maybe you are starting with $500 and you want to grow 2%, TP is 30 pips, stop loss is 10 pips. So this one, again, it will be able, once you key in there, it will be able to guide you accordingly, and you'll be able to know the lot size or the best lot size that you're supposed to use, okay? So this is basically to help you see the lot size that you're supposed to use, and also it will help you to know your daily goal in terms of profit, okay? So day one, you'll be targeting $2. That is if you're growing 2% of 100. So it is $2. The next day, because you have 102, so the target will be 2 or 2.04. That is 10% of 102, 2% of 102. Okay, so this will be your uh, guiding sheet that it will be able to guide you on the correct lot size and the target amount. Okay, so I'll put this link. You'll find this link below this video, and you can use it, and it will be able to guide you accordingly as a beginner in terms of identifying your stop loss and your daily growth profit. Okay, so that being said, thank you so much for tuning in, and in the next episode we are going to look at chart patterns. You're going to begin to look at some of the high probability chart patterns that as a beginner or as a Forex trader, you need to know, okay? So as you are going deeper, as you're proceeding, we are going deeper into the Forex trading aspect or the Forex trading technicalities, okay? So I believe you are finding value, and I believe this course is really helping you. So just do me one favor, ensure that you share and you like and you subscribe this video such that you don't miss any of my videos that I subscribe. Thank you so much, and see you in the next lesson.